A $5,000 credit card balance, paid on time every single month, can cost you over $9,000 in interest and take more than 7 years to pay off. That's not a mistake. That's the formula working exactly as designed. Banks have embedded traps into the financial tools you use every day, and they are counting on you never questioning a single one of them. Minimum payments are not a safety net. They are a revenue engine. The formula seems simple. Most issuers set the minimum payment at 1% of your balance, plus any interest and fees, or a flat dollar amount, whichever is higher. For a $5,000 balance at a 20% annual percentage rate, that means starting with a payment of around $100. But here's what that actually buys: 7 years and 3 months of monthly payments. Over that time, the interest alone totals $9,280, almost double the original debt. This is not a rare case. Nearly half of all credit card users pay only the minimum each month, according to the Consumer Financial Protection Bureau. Jenna Miller, a certified counselor with In Charge Debt Solutions, sees this every day. She calls the minimum payment the trap that feels like a lifeline. It keeps the account in good standing, but the balance barely shrinks. The math is designed so the payment covers just enough interest to keep the debt alive. Former bank product managers confirm this is no accident. One described the formula as a guaranteed interest floor, a way to keep balances rolling over for years and generate steady profit for the bank. Miller's advice is blunt: always pay at least twice the minimum if you can. Even a small increase in your monthly payment can cut years off your payoff timeline and save thousands in interest. The difference is dramatic. On that $5,000 balance, paying $200 a month instead of the minimum clears the debt in under 3 years with just over $1,100 in interest. The formula is public, but its consequences are rarely explained. For banks, the slow drip payment is not a flaw, it is the business model. Balance transfer offers often promise a clean slate, but the fine print tells another story. The process begins with a fee, typically 3 to 5% of the amount moved. On an $8,000 transfer, that is $240 added before a single payment is made. This upfront cost is easy to overlook, especially when the headline is 0% interest for 15 or even 21 months. But as the introductory period winds down, the real costs start to surface. Any balance left after the promo window does not just continue at a low rate. It is reclassified as a new revolving balance, immediately subject to the card's standard APR, often 20% or higher. If a payment is missed, the lender can invoke a clause that reages the balance, retroactively applying interest from the original transfer date, or hiking the rate to a penalty APR, sometimes nearly 30%. In one case reviewed by a consumer advocacy lawyer, a missed payment on an $8,000 transfer triggered $1,200 in additional interest over the next year, double what the borrower thought they had saved. The lawyer points to the contract language. A single late payment can reset the terms, wiping out the benefit of the initial offer. This clause is buried in the disclosures, rarely explained up front. Even without a penalty, the math is relentless. If the balance is not cleared by the end of the promo, interest accrues on the remaining amount plus the original fee. For many, this means the debt clock starts over, locking them into a new cycle of payments and growing costs. The relief is temporary, but the consequences can last for years. A 0% interest offer on a new purchase sounds like a win, but the numbers tell a different story. Field research by behavioral economists shows that when shoppers see a 0% promo, their average purchase jumps by 18%. That is not an outlier. It is the predictable result of how the brain reacts to what feels like free money. Dr. Shiri Levy, who studies consumer finance at Stanford, explains that zero interest cues lower the mental barriers to spending. Instead of weighing the full cost, people focus on the manageable monthly payment. The sticker shock fades and the cart gets fuller. Retailers and card issuers know this well. Big ticket items such as appliances, electronics, even vacations are routinely paired with 0% financing, nudging buyers to spend more than planned. The catch comes later. If the balance is not paid in full by the end of the promo, deferred interest kicks in. That means every dollar left unpaid is hit with interest dating back to the original purchase date, not just from the end of the offer. Contracts spell this out, but often in dense fine print. For a $2,000 TV bought on a 12-month 0% plan, missing the payoff deadline by one day can trigger hundreds of dollars in retroactive charges. One consumer, Maya Rodriguez, learned this the hard way. She used a 0% offer to buy new furniture, planning to pay it off over a year. An unexpected car repair forced her to carry a small balance past the promo end. The next statement included $340 in backdated interest, more than she had saved during the interest-free period. The promise of easy payments had masked the risk. For banks, the bigger balance and hidden interest add up to a reliable profit engine. For consumers, the true cost of 0% often arrives long after the sale. A higher credit limit does not mean you are wealthier. It just means you have more room to borrow. Behavioral economist Dr. Michael Baker points to a pattern. After a limit increase, the average cardholder's balance rises by about $400 in the first year. Banks know this, and they frame a higher limit as a reward, but the real effect is a subtle nudge to spend more. The mental shortcut is powerful. Seeing a bigger available balance feels like a green light, even though every dollar spent is still debt. In 2023, a field study found participants who were offered a $5,000 limit bump carried an average of $750 more within 3 months compared to those whose limit stayed the same. That extra debt is not just a number on a statement. It accrues interest, increases minimum payments, and raises the risk of missing a due date. For some, the illusion of safety leads straight into trouble. One consumer, Brian, described how his $10,000 limit made a $2,000 vacation seem affordable until he was juggling monthly payments and watching late fees pile up. The sense of financial security vanished as the balance grew. Credit counselors see this story repeat itself. Laura Chen, Director of Consumer Education at Cambridge Credit Counseling, teaches 3 simple fixes. First, treat your credit limit as a hard cap, not a target. Second, set an alert for when your balance hits 30% of your limit, because above that, your credit score can start to suffer. Third, before accepting a limit increase, ask yourself if you really need it, or if it is just making overspending easier. The money is not a gift, it is a liability, and recognizing that can be the difference between healthy credit and a debt spiral. A single missed payment can trigger a chain reaction that is almost impossible to stop. The first blow is the late fee, usually $35 to $45, automatically added to your balance. But the real danger comes next. Most major issuers will raise your interest rate to the penalty APR, often 29.99%, after just one missed payment. For someone carrying a balance of $2,500, that means the cost of borrowing nearly doubles overnight. Anita Patel, who once managed collections at a national bank, describes the process as automatic escalation. The system flags an overdue account, applies the fee, and schedules the penalty rate to kick in on the next cycle. If the account stays unpaid for 30 days, it is reported to the credit bureaus. At 60 days, the damage is locked in, and the account may be flagged for collections. Each step adds more fees, higher rates, and a bigger balance. The numbers add up fast. In a typical case, a balance of $2,500 hit with a late fee and penalty APR will take twice as long to pay off if only minimum payments are made. The minimum jumps, but the balance shrinks slower, and the interest compounds. Within months, the borrower can owe hundreds more, just from fees and extra interest. Jenna Miller, the counselor from In Charge, coaches clients to act immediately. Her script is direct. She tells clients to call their issuer, explain the situation, and ask for a one-time waiver of the late fee and penalty rate. Say, "I'm a long-time customer and this is my first missed payment. Can you help me get back on track?" Many banks will grant this if you call before the next statement closes. The key is speed. One missed due date should not turn into years of extra debt. but the system is built so that it often does. Today, over 40% of Americans carry credit card debt month to month. As financial tools grow more complex, the real cost of everyday borrowing often goes unseen. The rules are written in fine print, but the consequences are written in lives. What questions will you ask next?